Hello and welcome to our special offering, Know Your Debt Fund. I'm Sumaira Abidi, and today we're going to be analyzing the hybrid fund. Well, to be clear, the debt portion of your hybrid fund. And with me this afternoon is Kalpesh Ashar of Full Circle Financial Planners. Hi Kalpesh, good afternoon. But before I get to you, I want to quickly just run through the many categories of hybrid funds because not every hybrid fund is the same. So in 2018, when SEBI had done the rejig of the mutual fund scheme recategorizations, they had actually carved out six different categories within the hybrid space. So first, of course, is a conservative hybrid. Here we have the demarcation on the basis of the split between equity and the debt component, right, which follows through and through all the categories of debt funds. But here, of course, it is conservative and predominantly, therefore, invested in debt. The next category is either the balanced aggressive or the hybrid aggressive, where the demarcation again is on, how much can be in equity and how much can be in debt at any point in time. But do remember over here that an AMC has to choose one of these offerings. A single AMC cannot be offering both balanced and aggressive. Then there is, of course, the third category, which is the dynamic asset allocation. Now here, SEBI has not given any demarcation between how much should be in equity or debt. It is at the fund manager's discretion, and therefore the name dynamic. The multi-asset allocation mandates that there must be a investment into a minimum of three asset classes, and here as well there should be a minimum of 10% put in each of these asset classes. The arbitrage funds needs to have a minimum of 65% equity component, and here they operate by leveraging the difference in the price between the various markets. And then there is the equity savings category, where the minimum threshold is mentioned for both the equity and the debt component. And if there is any additional investment into another asset class, an FD like instrument or some such, it has to be mandated in the scheme offer document. But because we can't cover all six categories in this show, Kalpesh has chosen to narrow it down to the aggressive hybrid category and the dynamic asset allocation category. So Kalpesh, let's start off with aggressive hybrid, because this is where we see a lot of interest from the retail side. First, can you explain exactly what this category is and what does it bring to the table?
Okay, so Sumaira and all the viewers, in the aggressive hybrid category, like very categorically explained by you, Sumaira, the simple rule is that the classification goes, it has to be in around 65% to 80% in the equity component, and the balance 20 to 35% can be in the debt component. So ideally, when we speak in a day-to-day thing, we say that in a hybrid aggressive, 65% equity and 35% of debt is maintained. Now, when we speak about hybrid aggressive, and the reason for choosing this category for everyone is that the large amount of people who have invested in the so-called erstwhile balanced funds, they would find their categories predominantly existing in this category here. And second thing is that from a tax perspective, all this hybrid aggressive funds which are there still come under the equity part of taxation. So even the much favored funds, the more famous funds, infamous funds, I would say some of them, are all in this particular category. And the interesting part here is also the debt component, which is very, very, I think, interesting to talk about in today's times. So hybrid aggressive category has to be maintained in a particular way. And it's a very, famous type of a category which people are aware of. But of late, there have been a huge amount of, I think, even turbulence in this category.
Yeah, and Kalpesh, I imagine that every AMC would be treating the debt component pretty differently, right? So how would we know what's a good portfolio and what's a not so good portfolio?
Okay, so what happens in this is like SEBI has classified in the debt component exactly what they want the scheme to follow. It's a very ambiguous type of a scenario in this hybrid aggressive category. So more or less, it goes as per the fund philosophy or the fund manager's thought process on how the debt should be followed here. And if you were to see, a good portfolio, let's talk about the good one which you're asking. presently. In a good balanced fund in a hybrid category, I would say that the equity component should be the large cap oriented, and the debt component should have a major dominance of sovereign and AAA rated papers. Now, the simple reason I'm saying this is that when we perceive the balanced fund categories at advisors, we keep on telling our clients that there is an amount of conservatism in this fund for people who are seeking equity because of the debt component, and there is a bit of a cushion because of both the asset class having some type of proportion. So by nature, this category has to be conservative, but there are deviations. Now, but in a ideal type of a thing, and there are case studies to prove that this is the worst of times we are seeing where everything has gone down the barrel. But if you see a good portfolio, that even in the 1 month where again we've seen a little bit of a rebound, there the returns has been almost 10%. But then as you move down the ladder, the 1-year returns have been just minus 4%, the 3-year returns have been 4%, and 5-year has been 6%. Now, that doesn't speak a lot about the returns per se, but when you compare it to others, you will know that a good, stable portfolio has been at least able to hold its own in this scenario.
Okay, what about a not so good, portfolio in the aggressive space? Because, here I suppose the difference would be on the basis of what, the debt component?
Yeah, absolutely. The debt component, and that is what has been the death knell for many of the funds. That the debt component in this utter distressed times of liquidity problems, downgrades, defaults happening left, right, center, and the debt component has majorly let down the returns of this so-called hybrid category. So even in that, if you find the orientation has been AA and A-rated papers, which is again a risky proposition, and chasing the alpha type of thing in the debt space, which I never would advocate. And if you see that some of the portfolios also have a mid-cap type of an orientation, but of late the bend has been that many of the funds in the equity has at least shifted to large caps, but the markets have taken it down. And it's for all to see. This is just a case study we've taken up. And obviously, there are substantial evidences for this, that the returns in this, if you see the 1 month, obviously everyone has benefited. The return is 8%. But now is the stark reality of a bad performance, where the 1-year returns has been as staggering as minus 29 to 30% in this type of a category, hybrid aggressive. The 3-year returns have been negative 9%, and the 5-year returns have been, again, a dismal minus 1%. So everything has just been washed out because of, I would say, a bad handling of the debt portfolio of this category.
Okay. So basically over here, like you had mentioned, that the only demarcation that SEBI has allowed is basically how much should be in equity, how much should be in debt, but there is no control in terms of the credit quality. So that is completely at the discretion of the fund manager, right?
Absolutely.
Okay. And I want to just highlight to our viewers that, if you're wondering where you can access information like this about, what is the quality of your debt portfolio, the debt portion of your hybrid fund, or any portfolio for that matter, do remember that every AMC for every scheme will publish a monthly fact sheet. Now, some of them do it, right at the start of the month, but by and large, this fact sheet is released sometime in the second week. So the April fact sheets are still awaited, and I guess sometime next week is when they would be out. If you're already an investor, you would be getting this information in your email. If you are keen to check out the details of any other scheme, you can always go to the website of that AMC and go to the particular scheme and look for something called the scheme documents. Within that, you will find the monthly fact sheet, and you can also go back several months to trace what has been the change in the allocation, etc., or the change in investments over the in that particular scheme over the course of the last few months. Okay, Kalpesh, what about the dynamic asset allocation? Now here, the every decision is the choice of the fund manager, right?
Absolutely. And, as per the definition, what SEBI has given is that in the dynamic asset allocation, the equity and the debt component has to be managed in a dynamic way, in an efficient way also. But then there are some who have their own, methodologies and I would say not really adhering to the dynamic asset allocation aspect also. So dynamic asset allocation is a very different type of a scheme where lot of dependence is on the tact of the fund managers, how they decide to go about with the fund money of the investors.
Okay, so what would different portfolios in the dynamic asset allocation category look like, and how does an investor make the judge the difference?
So just to say, for example, the ICICI Pru Balanced Advantage Fund has been a benchmark in this, and I would like to, really say a bit of a good thing about this, that it is one of the funds which has stuck to its fund philosophy a lot. So it works by the price to book value ratio mechanism from day one, and it has not even deviated from that strategy at all. And if you see, what it simply does is it increases its allocation in falling markets, and in the other cases, it does the vice versa of it. And this is pretty evident right now that when the markets have reached a bottom, the equity component of this particular scheme is almost at 70 to 75%. So that speaks a lot about following a certain discipline. And if you were to see the returns also in in a type of this type of a scheme, they are a little bit more rational than the ones which we've generally seen on the hybrid aggressive part. So the ICICI Balanced Advantage Fund is the one in the dynamic asset allocation which has stuck to its core principle, although in its debt portfolio, it has been thriving on AA and AAA rated papers, but they have their own conviction about having invested in AA papers. And thus far, I think it's doing a reasonably good job. While on the equity component, they have always stuck to the large cap component.
All right, on that note, we'll take a very quick break, come back in just a bit. On the other side, we're going to talk about how returns from the hybrid mutual fund category actually stack up against different categories. I mean, do you really need to be in a hybrid fund? All of that is lined up next.